Portfolio Builder members, welcome to your 831 Trade Alert webinar. No changes for existing members. If you're new, we're going to show you how to get started and follow our program. It's pretty easy. We're starting off looking at our track record today, and we've had a record-breaking return in August. The total return for every dollar invested is 8.9%, and we've still got the rest of today. So I'm hoping we can crack that 9% in a single month with our buy and hold strategy. Now, keep in mind, this is the trading plan that doesn't use options. So this is very passive. We've made very few changes. And what I'm going to teach you today is exactly how we predict the markets, how we hedge, how we use risk management, and can do it completely with just ETFs. So welcome, everyone. Now, first off, I do want to point out another item. During the March crash, we had a lot less volatility. So if you looked at the S&P 500's total return during March, when we had that sharp sell-off because of the CV, can't say the words on YouTube or they may ban you, it went down 34%. We only lost 9%. So we've actually cut that maximum drawdown by 75%. But look at the S&P 500's return against ours today, and we're spanking it on the butt. So we'll show you how that's done. Bottom line is I focus on macro. We were looking at investing in China when the trade deal was signed. Skeptical, but still investing in it. And all of a sudden their market crashed early in January, and this all came spiraling out of control. So we've been a few steps ahead of the crowd, and that's really provided a lot of value to our clients. Okay, so we've been doing this program for just under 3 years, 25% return in 2019, 12.6 total return in 2020. If you got started with us in July, you're already up over 17% in 2 months. Julio said, yeah, so there's, we've separated the buy and hold crowd from the pro crowd. So if you're not in the pro product, you won't see their trades anymore. That will be a little later in the day. But the good news is we're giving buy and hold clients a daily webinar now. So you'll actually have access to me daily every morning at this time moving forward. So very good. Let's go ahead and jump into the trade alert, and then we'll explain the methodology behind our strategy. So the current trading recommendation for existing members is no changes. We're long stocks and silver currently, and that's done very well for us. If you're new and you're just getting started, for every $1,000 you want to follow with our trading plan, we're currently recommending 10 shares of URPO, which is 3 times leveraged S&P 500 ETF. This comes at a 1% cost expense per year. So it's essentially giving you a huge loan for extremely cheap. So we really like URPO. It's $62 a share approximately. And so that will take up about 62% of your total assets. The next trade is 5 shares of SLV. That's the spot silver product. This is acting as a hedge to a certain degree. And again, that will eat up about 12% of your portfolio. So you still have a lot of money on the sidelines. We'll talk about what that money is for, but it will be to protect against downside risks in equities, primarily through treasuries at the right time, and perhaps the volatility indexes that we can use to also hedge our long equities position. But bottom line is our prediction is that the SPY is going to continue melting up unless something catastrophic happens. And this will be primarily due to quantitative easing and rising interest rates and treasuries. So we'll jump into all of that. But really quickly, this is the trading plan. If you want to start following our program during your free trial, this is all you have to do. If you had $10,000, you'd be buying 100 shares of UPRO and 50 shares of SLV. If you had $2,000, you'd be buying 20 shares of UPRO and 10 shares of SLV. So it's quite easy to follow the trading plan. And again, this is done quite remarkable for our clients with the best return we've had on the books in August. So just in the last 30 days. And I do suspect we can see this hop even higher to close out the month. So let's take a look at the indicators that we're using to predict markets here. So first of all, there's a number of things I'm watching that give us a heads up that there's trouble ahead. And so a weakening dollar is actually beneficial for our positioning, especially for precious metals. It'd actually be a rising dollar that would tell me we are having trouble ahead for stocks. So the weakening dollar is not a big issue right now, but it does give us a hint at what the Federal Reserve will do with policy to try to protect the dollar. And so if we listen to Trump recently, what's he talking about? Instead of new highs in the stocks, he's now suddenly tweeting about how he's going to make the dollar strong. And that's because we've had a 10% correction since it was trading at very high levels. If we zoom out during the March crash, so if we go to the daily chart and look at that, just a tale of two cities. First, we had the dollar index rocket up to 103, which again shows there's not enough dollars. Everyone's trying to get dollars at the same time. That created one of the most vicious market crashes that took out bonds, stocks, oil, gold, everything at the same time. Big margin call. The Fed reacted with $3.5 trillion quantitative easing, and that immediately sent the dollar falling. So a lot of people are predicting this will continue to crash. And if it does crash too much, that would be a problem. But if we zoom out and look at the grand scheme of things, we can see there's still a lot of room for the dollar to weaken before we should get overly concerned. Okay, the next chart we're going to examine is a breakdown of the S&P 500. So this is the SPY broken down per sector. And so our big bet is that we're going to have rising interest rates in treasuries. That's going to potentially unleash several $1 trillion into the S&P 500. And specifically, instead of favoring the technology stocks, I'm expecting that we're actually going to see the beaten up portions of the S&P 500 get a bid on this. So we're looking at down below mainly the banks. This is really the critical asset that we want to see rising for our prediction to really play out here. And so the banks really benefit from higher interest rates because they can make more money loaning out capital. Now, today we've seen a little bit of a dip, but there's some pretty interesting things today. So first of all, we had the 5-to-1 split for Tesla and Apple, which doesn't change its market value, but it makes it cheaper for investors to grab 100 shares and protect it with a put. So that married put strategy suddenly becomes a lot more affordable for all these retail investors trying to play Tesla or Apple. Bottom line is, as I'll go through this presentation, I'm still expecting interest rates to rise and for this to push the S&P 500 dramatically higher into the election. Now, the biggest risk for this prediction is we must pass stimulus. We need more stimulus. The policy being implemented by governors and mayors is still highly restrictive to businesses. So these banks remain at extreme risk unless the government's going to continue to bail out the various businesses and consumers who just don't have income to pay for their rent. So Wells Fargo is namely the biggest bank that I'm concerned with in the United States. And again, in our pro strategy where we do trade options, we have a little more exposure, almost twice as much exposure to URPO, but we're paying a lot of capital to hedge by shorting the banks with options. So if you are interested in making a little less, but doing it safer, that's what our pro strategy is all about. And that happens this evening. Okay, so the banks are showing some weakness this morning. And guess what? Treasuries have taken a little bit of a bid this morning. We'll take a look at the underlying of all this. But this is the main prediction, is that technology will start to cool off. The breadth of the S&P 500 will consolidate, and we will push even higher on the S&P 500. Now, this is the TLT against the SPY, and this is actually the way we prefer to invest in the markets. And so what we're looking at in 2008 and 2009, in the blue, you have treasuries, TLT, and in the red and green, we have the S&P 500. And so this is called the risk parity strategy. This is what we've done for most of the last 3 years. And unfortunately, because the Federal Reserve was forced to suppress interest rates, treasuries are a very risky bet right now. So right now we are only investing in the S&P 500 because I would actually argue you have better risk parity owning tech and banks at the same time than you do with the classic bond equity strategy. So we will be right back to the classic risk parity strategy soon as treasuries have been allowed to reset, which I do believe is in the cards in the coming months. And again, could drive the S&P 500 much higher. So in the blue line, you can see treasuries went up about 40% while stocks crashed 50%. So if you simply were half treasuries, half stocks, the 2009 crash didn't even put a dent on your net worth. But over the course of time, as quantitative easing came in and we did recover from that financial crisis, mostly with derivatives in US housing sector, what happened to treasuries? Did they get killed? No, they still made about a third of the return of the S&P 500, but provided this masterful hedge against your long equity position. So the entire world knows this. That's how Ray Dalio became the most profitable hedge fund manager of all time, and what almost every big central bank, pension fund, and hedge fund uses as the go-to strategy. Now they might get a little cute with exactly which equities or exactly which treasuries they are purchasing, but this is the bottom line basic strategy that we teach investors and have used for the last 3 years. And what I'm going to show you is this strategy has broken recently. Okay, and that is very bad news if you're not reacting to it quickly. So here is what went wrong in March. Two things. Number one, when stocks were crashing, this TLT should have continued to rise. But because the crunch, the liquidity crisis was so massive, because so many investors were caught off guard, we actually had stocks and treasuries crash at the same time. This is when the Fed knew the entire system was on the verge of collapse and essentially had to bail out everyone. And not just in the United States, they bailed out every central bank around the world. And they did it with about $3.5 trillion added to their balance sheet in a very short order. And so what happened? We had treasuries and stocks go up at the same time. And so our basic prediction here is that treasuries must reset to a fair value before the risk parity strategy will work. And so this can be seen by predicting that these two will cross back over. And we can see we are on the verge of that because the Fed is now starting to take a step back. They're not ramping up their QE. They've actually reduced it dramatically from approximately anywhere from $300 to $500 billion a week of QE down to only $20 billion a week of QE. So when we look at the debt issuance from the US government compared to how much the Fed is buying, the overall forces are for interest rates to rise. And again, that's going to potentially push a lot of money out of treasuries. A lot of money sitting on the sidelines in cash is likely to chase stocks. That's our prediction here. Now we have some good leading indicators to tell us that something else is on the horizon. We'll look at that, but right now, this remains our prediction. Now, this is a fun leading indicator. This is a cryptocurrency called Ethereum, and it is overlaid on the NASDAQ. So if you think of Ethereum more like a Microsoft platform, but for decentralized technologies, you can start to understand why big money treats Ethereum just like any other technology stock. And because it's so volatile, we can actually get a relatively good heads up when there is volatility coming into the technology sector. So note that it was predicting a crash way before the sell-off in March. And it also predicted the April rally way before we bottomed out. So currently Ethereum is pointing towards breaking into new highs, and you can see that the QQQ is chasing it. So this is one of our favorite leading indicators. The bottom line is that the big money has inside knowledge, and they take profits on the assets that have the most profitability with the least liquidity first. So when the big players start dumping things like Bitcoin and crypto, you have a relatively good heads up to start to get defensive. So in our portfolio, I'll show you how we can do that with two simple changes and be very confident being long stocks. Right now, of course, this indicator is telling us that there's more upside ahead. Now in this chart, we have a few more indicators laid out. First of all, we have the QQQ in the green and red line here. We have Ethereum in the black line. Call it dark money if you want. The blue line, we have the TLT. And in the yellow line, we have the S&P 500. And so the main prediction here is simply that interest rates will rise. This will be beneficial to banks and energy companies and industrial, all the beaten up parts of the S&P 500, and that we're going to see technology start to slow down or even have a small pullback. So we'll see this essentially by watching the blue line drop and the yellow line rise. And that's the big picture of what we're looking for in the coming weeks and months. Now, the big stipulation here is we must pass stimulus. The Fed can sit there and buy up debt, but if the government's not issuing new debt because Congress hasn't passed new spending bills, then this economy is going to fall off a cliff quickly. So where are we at with that? First, Pelosi wanted $3.5 trillion, and Republicans offered $1 trillion. She came down to $2.5 trillion. They've slowly but surely every week budgeted up by $100 billion. There was rumors of a skinny deal getting through, but this is going to become more and more problematic. So if we don't see stimulus getting closer to the finish line as we approach the end of September, watch for us to completely reverse this positioning and actually bet that treasuries and the VIX travel much higher, which we can easily adapt into. So I'll show you that in a moment. Here's another look at these same charts. And again, we're seeing exactly what we would expect. So we're seeing the Ethereum and QQQ outperform today because TLT has jumped, and we're seeing weak banks. But as we go through our presentation, what I'll show you is that I actually expect that interest rates will continue to rise over the long run, and that we should be long banks over tech currently. Now, the SPY does a great job. It has tech and banks in the same index. It's the top 500 companies in the world. Now, this is an interesting chart. We're also playing precious metals. I like silver over gold now that we have the printing presses running worldwide. But it's important to know that if interest rates rise too quickly on treasuries at a faster pace than inflation, which is almost guaranteed until policy stance changes, which allows businesses to reopen and get the economy hot with lower levels of unemployment. This chart is critical. So GLD is tracking the TLT now, which means if interest rates rise quickly, this could be quite negative for gold, silver, and cryptocurrencies. So when we first saw a little bit of a temper tantrum in interest rates, we saw a large sell-off in GLD. We've got a small bid on treasuries today, up about 0.85% on the TLT. And once again, you're seeing that strength in gold. So those are tied to the hip. Now, this relationship was the opposite until March. So a lot of the correlations we've been following have begun to change since the Fed had to manipulate markets to prevent a crash. Now, this is my favorite way to predict interest rates. And if we can predict interest rates, we can predict the SPY. And from that, we can predict precious metals. So copper is used when we're building things. China is the primary buyer of copper. In fact, I think they almost buy up half of the commodities of the world. So they really are the growth engine. So if copper is selling off at a faster pace than gold, that's very negative. That means we're not growing, and look for a stock crash. On the other hand, if copper is rising at a faster pace than gold, that means we are recovering. And so if we look at all the data, it's quite clear that not only are we recovering globally, as long as governments use fiscal to stimulate their economies and change and reverse their policies to reopen, that we can safely get this show on the worldwide. And so China is now sending all this footage of basically parties going on in Wuhan, really laughing at America, who's still locked down. So right now, copper is rising at a faster pace than gold, indicating rising interest rates ahead. If we go to the yield curve, we can look at month over month and see that the entire spectrum of interest rates are rising as expected, which again is very good for banks. I'm actually looking for the 30-year treasury to head towards 2% when I think we will be wanting to get back into treasuries to help hedge our long SPY position. Right now, it's just too cheap. The interest rates we're paying on treasuries currently is pricing in a complete catastrophe ahead. And unfortunately for bondholders, I don't see that in the cards. I see a pretty smooth recovery from here. Again, the biggest stumbling block could potentially be not passing stimulus while the US governors and mayors refuse to reopen their economies. Now, the debt issuance next this week and next is light. So usually it's the $300 billion a week issuance that puts pressures on yields. This week, we only have $165 billion being sold. So I'm not going to predict a big quake in treasuries this week based on that level of issuance. So far, we're selling our debt quite easily. So this does continue to push precious metals and technology stocks up higher. But over the next year, we're going to have to sell $5 trillion of debt. And the Fed's only indicated it's willing to buy $1 trillion of that. So that's a huge mismatch and most likely will cause interest rates to rise. This is where the Fed tells us what they're going to do ahead of time. So we keep a close eye on that. If they were to reduce the quantitative easing, I would want to bet that treasuries actually go up and we get a sell-off in stocks. If, however, we see they stay flat at 80 billion a month, that's just perfect to keep stocks rising and for the treasury market to really sell off is really what we're predicting here, as long as this stays put. If they were to dramatically increase the amount of QE, I'd want to get more aggressive in precious metals and expect that we're going to have a banking failure, basically. So we'd add more put options on banks, which again is not part of our much more simple buy and hold strategy we're teaching you today. Now, the repo markets haven't been used for a long time. This is essentially how we can see if banks are out of cash because they've had to buy too much US debt. Right now, foreigners are flocking over our debt with a weak dollar. This provides a great opportunity for them to buy US debt. So we're easily selling our debt. And again, this is not signaling any problems for us whatsoever with dollar shortages, which would be negative for stocks. This chart is the effective federal funds rate. So you can see we're essentially at 0% interest rates. We were just at 0% interest rates after the 2008 crash for a half decade, and now they've signaled they're going to do that again for another half decade. It's not clear how much QE they will do. I'm expecting that they're not going to do more than $80 billion a month unless we have a significant stock crash, which I don't think will happen unless interest rates become too attractive or we fail to pass stimulus. So those are really the two main items. Also, we look at two different types of inflation. Really, this is the only one that really matters, which is the United States core inflation rate. It's sitting at 1.6. The Fed says they're going to let it run hot for a long period of time, which means we're going to have easy monetary policy probably for the next several years at a minimum, regardless of how bad inflation gets. Now, the fear is that if they do let the economy run too hot and print too much money, and we do get to full employment, that we may get runaway inflation like we had in the 60s. So we're keeping a close eye on that. And this is essentially when stocks and bonds crashed for about 15 years straight, and Paul Volcker had to hike the federal funds rate up to 18% and was the best return for gold in history. Also, this is when Nixon decoupled the dollar from gold, so it let it really skyrocket from there. Okay, so here is UPRO. Again, this is a 3-time leveraged ETF on the S&P 500. It pulls that off with call options and future options. And um, our prediction is higher. This can go much, much higher. Really what we need, though, is once again stimulus. Here is the chart of silver. And again, we're looking at the 2010-2011 run-up. This happened primarily due to quantitative easing, but also because there was a recovery. We actually had a real recovery. We were doing lots of money printing. We were picking up lots of inflation. And so we really want both. We want a rebounding economy, lots of money printing, and quickly rising inflation to see this silver pump much higher. So right now we have the money printing, but we don't quite have the full reopening of the economy due to policy. And we may run out of stimulus, which will make it hard for the Fed to continue buying debt. So this is, again, very risky if we don't get stimulus. We're keeping a close eye on that. Freeport-McMoRan is a company I like to pay close attention to. They essentially have a monopoly on the copper market, or at least the largest share of copper. And again, this shows a lot of strength when we're having a recovery. Look at that run up in 2009. We did play this in the pro strategy for quite some time after the March crash. Not in it currently. Now, Moderna was a vaccine company we had a lot of interest in because of its ties to the NIH, which has a patent on it, and then Bill Gates, who had been pumping it. But suddenly, Dr. Fauci's not in the picture with Trump, which is alarming. And also, Bill Gates has stopped promoting Moderna. So we did very well playing Moderna. Currently, we're sitting on the sidelines on that. Keep in mind, the main vaccine companies that Bill Gates is now promoting are highly weighted in the S&P 500 SPY. So we have a huge exposure to the main one, which is Johnson & Johnson. So again, vaccine headlines would be very good for the SPY. And we're nearing that point. So we're currently not playing Moderna. Now, this is TMF. So this is a leveraged treasury product. This is what we typically like to have half our portfolio in. So half in treasuries, half in the SPY. Makes it very hard to have a losing period because it's essential for the government to make treasuries go up over the course of time so they can continue to borrow debt. And for the employment to recover, we need S&P 500 to trade at high levels. So it's really a national security risk if those don't perform. Now, that doesn't mean it's not in the government's interest to allow interest rates to rise for a short period of time to become attractive and competitive. And that's exactly what I'm concerned may happen and why we're simply long the S&P 500 at this time. So again, if we start to see a failure to pass stimulus, look for us to start off by adding TMF to our positioning. And if it really looks like they're not going to create a deal, to simply exit UPRO, and we can play TMF, and then UVXY is my favorite VIX ETN that we can just simply buy and hold. So this did run up from as low as 10 all the way up to as high as 134. So even a smaller 10% position in UVXY can give us a lot of hedging alongside our treasuries. So we're not there yet. Right now, still predicting higher highs on the S&P 500, and that the stock market is actually rewarding the delays in the stimulus. They're predicting the longer the talks go on, the larger the stimulus will be, which works until, of course, they can't pass anything in time at all. Now, a few currencies that provide a lot of value to track daily is the Chinese currency. So we want to focus our macro attention on the two largest economies, which is the US and China. So if the Chinese currency is strengthening, that typically means a period of peace between the two nations, which is funny because we know we have our naval fleet sitting there bullying the Chinese on the South China Sea. They have essentially insurrected protests all over the United States. We're about to delete TikTok and WeChat from America. We're about to cut off the semiconductors from Huawei and the Chinese have failed to meet their trade deal. So you'd think that this would be heading towards 7, showing that there's stress ahead. Bottom line is neither country can really hurt the either too much without taking both down. And so I'm essentially predicting that China is going to buy a ton of US goods in return for us not cutting off all their technology companies, which would be Huawei, TikTok, WeChat. Navarro was just on this morning saying that we won't stop there. We'll essentially go after all their companies. So we'll see. It's getting closer and closer to the election. The other currency that's important for Asia is the Hong Kong peg. This is at the strong end of the band. It's allowed to trade from 7.75 to 7.85. If it's on the strong band, that means local currencies are getting out of their currency and buying the Hong Kong dollar, which is a way to save your value and to hold wealth safely. So again, this being on the strong end of the band shows weakness in Asia. And if you look at emerging markets ETF, this is probably the biggest warning signal we have today. Is EEM is down 2.5%. Wells Fargo is hanging in there. This bank has the most exposure to commercial real estate of all US banks, not to mention residential real estate. And clearly that's what's at risk here. If we don't reopen quickly enough and change local policy to allow businesses to operate at full capacity without masks, then there's more trouble ahead. So either the government will have to bail out all these individuals, companies, and banks, or this goes much lower. So again, in our pro strategy, we're buying put options on banks to protect against that risk. Now in London, there's a bank called HSBC Bank, which has exposure to Hong Kong's real estate, the most overvalued, highest priced real estate in the world. This is actually trading at 2008 levels. It is extremely alarming. And if this goes below 21 for a substantial amount of time, expect us to ratchet up protection and even bet on a sell-off in stocks. Deutsche Bank is a German bank, which is highly tied to China. And interesting, it's not showing that weakness. So Wells Fargo is not at the 2008 levels, and it's flatlined. HSBC Bank continues to sell off. It is at 2008 levels. Deutsche Bank is showing a almost 100% return from the March lows. So mixed signals from the three main banks that we watch. Now, this is the main bond markets that compete for capital around the world. So we have the Chinese bond up top, then we have the US in black, then we have the Japanese bond in orange, and the German bond in turquoise. And so we can see that the recent trend has been rising interest rates. And almost without exception, anytime that you do quantitative easing, it takes stress off the bond market and allows money to flee into a new asset, typically stocks. So you end up with rising interest rates and higher stock prices during periods of QE, which is the period we're in. So it will take a substantial shock to the market to change this, this outcome. Okay, so let's go ahead and take a quick break and see what questions we have out there. I do have some news we can cover, and we can review the trading plan. Okay, so we have more people in the webinar now. Another shout out: Art, Ash, Charles, Dave, David Fast, Donald, El Peje, Eric, Haluk, John, Jonathan, Julio, Ron, Sam Gold, Sol, and Yao Sung. Oh, let's see. El Peje says, "What's up?" Not much. How are you doing? Any questions from the crowd as to how we're playing the markets? Okay, let's see. We have Charles asking a question. Go ahead, Charles.
Okay. Are we able to watch this later on as a recording?
Yes, sir. So if you go right back to the email that sent you to the live webinar, after this is over, that will replay today's episode.
Thanks.
Yep. Any questions about how to follow the trading plan?
I thought it was good.
We try to keep it as simple as possible. Oh, David has a question. Go ahead, David. Go ahead, David. It looks like David's going to type his question and he's having issues with his audio. And then El Pepe can speak as well. Or El Peje.
Question. How are you doing there? Sorry, but about the nickname is Jose, the name.
Oh, Jose, no problem. How's it going?
Good, good. Yourself?
Doing great.
Nice. You guys only focus on traditional stocks? You guys don't venture into the cryptocurrency world?
Well, I think you can make more money with silver, especially with options on silver, than you can with cryptocurrencies. In our boot camp, we do potentially trade cryptocurrencies.
Okay.
But yeah, we're playing the biggest markets with the most liquidity, and primarily are attractive to retirees with rather large accounts. So most of our clients are interested in safe, steady returns, not playing risky strategies. So if we were to play something like Ethereum, it'd be no more than a 1% asset allocation.
Got it.
Let's see, David, you want to try again?
Hello?
Hey, David, how's it going?
Oh, you could hear me. All right. I wasn't sure if it was working. Okay. So my question is basically it has to do with what you're talking about earlier, the relationship between cryptocurrencies, bonds, and interest rates, because I remember you said something about how you can use crypto to basically predict a stock market crash, and and you can tell that the lows in crypto happened about 10 days before the lows in the S&P 500. But I also heard you say that that the interest rates on the bonds also have something to do with how crypto trades as well. So I was just wondering, like, you know, if you see a crash in crypto, you also have to take a note at what the interest rates are looking like as well, to really make sure that it's a real stock crash, not just like you know, a small correction or a sell-off.
Yeah, so here's the basic warning to anybody playing precious metals or crypto. So this is it. So when we do quantitative easing, it tends to make interest rates rise rapidly. If those interest rates on treasuries are rising faster than the inflation, which I'll pull up. Okay, so we're getting some inflation rising after the March crash, after it collapsing. But if those interest rates rise at a faster pace than inflation, it would be detrimental short term to precious metals as well as crypto. So yeah, it's more complex than just saying Ethereum will predict everything. But yeah, you're right. So here we can see Ethereum predicted the March crash as well as the April rebound quite accurately. So it's so volatile, it can give you some head fakes. So we had a little bit of a head fake right here, and then it shot right back up. And then guess what happened this morning? Treasuries were up, technology stocks are up, and banks are down. So it's providing a very good leading indicator for the bigger markets. So yeah, you've been a good student, David. A+.
Thank you.
You're welcome. Good job. Any other questions?
Oh no, I'm okay.
Okay, great. Let's see, any other questions out there, guys? So this is a daily webinar for our buy and hold clients now. So if there's any changes, you'll know, as you've been following this for quite some time, you do know that we rarely change our stance. And if you're on a free trial, again, you'll have this daily during your free trial to ask questions. If you do want to be following the trading plan, though, it takes very little effort. So per $1,000 following the trading plan, you buy 10 shares of UPRO, you buy 5 shares of SLV. And right now, SLV is acting like a treasury product, but supercharged. So if this is basically a better way to hedge our portfolio currently than treasuries, because there's more outcomes where silver ends up winning in the short term than there are for treasuries. With that said, treasuries continue to be resilient, and right now the SLV is highly correlated to the TLT. So again, it's a supercharged hedge, and in the long run, the only way out of this mess is a lot of debt issuance by governments and a lot of quantitative easing by central banks worldwide. So they may stumble to accomplish this in September, which we need to embrace and prepare for. So again, we're not even in September yet, but as you can see, we are basically planning for the Democrats to refuse to do a deal that the Republicans would accept and create a stock crash. So that is likely weeks away from today, but that is the number one concern I have. Now, a failed stimulus could be good for treasuries, but potentially bad for silver. So there's no guaranteed solution to being long stocks and have the right protection to the downside. Let's see. So quite a few folks out there who I've never seen before, mix them with our paid clients. Jose says the next few months are going to be interesting. Oh yeah. So we got the election coming up. It's looking like it's going to be a landslide for Trump at this point. So we know how to play the markets with a Trump victory. So again, we would be not focusing on this getting carbon emissions to zero policy. Really, if you want to know what you should buy if Joe Biden wins, listen to Bill Gates. So I listen to Bill Gates very closely with every interview. And so his main goal is to get carbon emissions down to zero by 2050. And so they got to start making dramatic moves in that direction. If Trump wins, he's good buddies with the oil and old school energy companies. So we'd expect the opposite. And clearly Trump is being backed by the big banks. So it looks like we basically have a battle of the tech pharmaceutical media companies pushing the Democratic side, and then the energy and banking companies pushing for the Trump victory. So we have to be prepared for either one, and we are. So we know what to do depending on who wins the election. Okay, very good. Well, I'm going to go ahead and jump into the news. Quick little advertisement for our product. Our buy and hold advisory is only $1,000 a year. You get the daily update. A lot of people enjoy the content just as much as the trade. So we will teach you everything you need to know to be highly educated and sophisticated with your investing, predicting the future. You'll know what's going on in politics, economics, and mainly what's happening between US and China. That's really the big deal breaker here. Now the price is going up to 2,000 a year on Friday, so get a hold of your consultant to upgrade. Okay, so let's go ahead and jump into the news. And again, if you guys have any questions out there, please post them in the chat box or raise your hand and you can speak live. Also, I will point out, if you do upgrade your free trial today, you get a 30-day bonus in our pro system, which provides options trades. Now, I don't try to normally get greedy with options trades. I actually try to reduce risk. So currently we are short banks while being long the SPY. Okay, so let's look at the top headlines that I have grabbed over the weekend. So Joe Biden is suddenly plunging in the polls. I mean, it is reversing rapidly. If you asked me a month ago or 2 months ago, I would have not predicted such a massive swing in the polls. People were beating up Trump on his virus policy, but now it's actually proving to be the right policy. And so now, with the protest riots getting out of control, with people getting sick and tired of being stuck in their homes, this is all backfiring on the Democratic Party. So will he start to get out and try to change this? We'll see. Will he do a debate? We'll see. Pelosi's actually told Joe Biden not to do a debate at all. This is what everyone got wrong. Now, if you listen to NPR, if you listen to MSNBC, if you listen to any of the really the left-wing media, you're going to get these horrific headlines that everybody's catching it. But what they're ignoring is that the cases for the hospital system and deaths are dropping like a rock, which we predicted several months ago. And the bottom line, this is what everyone got wrong. This is what they didn't tell you, is that 80% of the population is already immune to a degree to the virus. And that's because the first SARS in China 2 decades ago went global and nobody talked about it. So that did give people a line of defense. And that's why every model that was hyped up in February and March failed. They were predicting 96,000 deaths for those evil Swedish who refused to lock down. They ended up with 5,600, and most of those were in hospice. So the stats are in. Really, the policy that makes sense is to abolish all policy immediately. Really, all you need to do is protect the nursing homes and get the show on the road. So that's what can happen. That's why stocks are flying high since investors figured this out in March and the Fed came in with the stimulus. What's holding us back at this point will be policy, which is, again, state policy, not federal policy. State policy has to reverse course for a recovery. And that's what's holding up the stimulus. The stimulus that the Democrats want will allow them to keep their states shut down. Republicans know that the only way to force them to reopen and get this show on the road is to hold back stimulus. So it's funny, the long game for a recovery would actually force a stock crash right before the election. So I don't think Trump's going to do that. We'll see if the Republicans will cause a stock crash and refuse to give the Democrats the money they want. My bet is that they will figure out a way to spend a trillion or more before the end of September. But again, the closer we get to the end of September, the sooner this will, the closer we get to September without a stimulus, the more defensive we will get. So we can do that by buying treasuries and buying that VIX product and starting to pull back exposure to S&P 500. And that's how we'll play it with the buy and hold. With the pro strategy, you have put options on the banks. The banks are the ones that are going to go bankrupt if they don't bail out everyone. So here are the cases by region, still slowing down. If you look at the hospitalizations as well as the deaths, it's very low. And then once you realize most of the deaths were over 75, CDC just put out data last week, 75% of all deaths were over 75. And most of those were, again, had 2 to 3 comorbidities. So you're basically dying of cancer regardless. You're at the end of your life, and then you happen to catch coronavirus. They're going to mark that as a COVID-19 death. Now, this is important. We're looking at traffic congestion, and the more traffic congestion, the better. That shows recovery. Now, has consumer behavior changed? Has the workplace changed for good? Maybe. So we have found that a lot of people can work from home just fine and save time and money. But in general, we are seeing traffic congestion pick up, which shows recovery. That's good for the beaten up portions of the S&P 500, which is what we're long. Okay, so wake up, America. We've been had. China is throwing parties. Remember when they were sending all this crazy footage of them welding buildings shut, people dying on the streets? They were marching to create 23 hospitals. I mean, it looked like a real zombie apocalypse coming out of China. And now they're throwing parties. They are laughing their ass off. They completely derailed the US economy. And that was by design. There's no question this was, but by design. if and when Trump wins, I expect them to get very aggressive with China and force them to essentially buy several $100 billion of US goods or else. And so once we realize China is really screwed if they don't do this, it does lead me to think they will eventually take the knee. Walter Bloomberg, Navarro says US will go after others, not only TikTok or WeChat. We're looking at a Microsoft Walmart buyout of TikTok. Microsoft is in bed with the Chinese, unfortunately, but I guess this is better than it being operated by a Chinese company. Now, if you do look at the source code, there's lots of content out there. People are looking at the source code of TikTok, and it was able to download everything on your phone. So it was definitely a spy tool for the Chinese. Now, the Chinese have made a new rule saying, hey, you can't, ByteDance can't sell TikTok without their approval. So they very well may not allow that. If you think that about the fact that there's 100 million Americans who use TikTok, are the Chinese trying to punish Trump, force him to make that call before the election? I doubt it. I doubt Trump's going to do anything to create chaos before November 3rd. So it'd really be the Chinese provoking us, if anything, on that geopolitical end goes off course. Here is the daily cases, hospitalizations, and deaths. So we lucked out. This man-made virus was not as deadly as they hyped it up to be. You really have, in fact, if you look at the deaths per year for children, if you're worried about your child going back to school, they're 50 times more likely to die hopping in a car than they are from the coronavirus. If you're over 65, 6 out of 100 are dying, but 5 of those are having 3 comorbidities. So if you're over 65 and you don't have a comorbidity, 99% chance you're going to be fine. So again, every decade younger you go, add another 0. So this is incredibly bad policy at this time. Okay, Daniel Levitt, with COVID, I am convinced the government officials are lying to us and insulting our intelligence. It is not their mere incompetence. It is intentional to drive their policies. Even worse, it is clear that most people don't even realize that they're being lied to. Sad but true. We've got people in my city walking around outside by themselves with a mask on. Okay, we're continuing to see more violence related to the protests. Now we're seeing Trump fans come to protest alongside the BML crew, and now they're starting to kill one another. So I am actually predicting this will get more and more violent. I'm really afraid there could be a mass shooting at one of these events, and also that no one's going to accept the election results in either direction. So this is going to potentially be a very chaotic period of time, almost regardless of what's happening with interest rates as we get closer to November. I do want to get much more protected against unexpected chaos. So probably around October at the latest, we will start getting more defensive for buy and hold, expecting something crazy to happen here before the election. Gordon Chang, will China manipulate US election results? South Korea's Moon apparently stole the April 15th National Assembly election with help of Huawei. The Fed now owns a total of 23,000 different securities. So it's very hard for a stock crash when the Fed's pumping $80 billion a month into the markets. But keep in mind, the government's pulling out about 150 to 300 billion from markets per week. So unless interest rates rise, that money has to come from somewhere. Right now, it's primarily coming from foreign investors. So that's the good news. But if we see that US banks have to start picking up the slack and that interest rates aren't rising, that would be another reason to get concerned about equities. So we really want to see, for a safe rise in the S&P 500, Treasury interest rates slowly rising, or the TLT slowly dropping. So without that, we got to really think twice about where this money is coming from. Is it coming from cash on the sidelines, or are we going to have to be selling equities to pay for this debt? Okay, national poll among independents, a 10+ swing for Trump. Democracy Institute shows Trump up nationally in battleground states. So really this election only matters about battleground states. Trump has taken a serious lead suddenly on that. CDC quietly updated the COVID numbers. Only 6% of all the 153,000 deaths died only from COVID. The other 94% had 2 to 3 other serious illnesses. And the overwhelming majority were over 75. Jared Dillian, we won't know the winner of the election for weeks or months as all the mail-in ballots are counted. Trump will claim victory and Biden won't concede. This will stretch into December. If you ever wondered if there will be another civil war, this is the time. And I agree with that. Unfortunately, it looks like we are headed towards a civil war. China won't sell TikTok and the source code showing it spied. So we'll see. This is very interesting development. So we are basically threatening to cut off Huawei from semiconductor chips out of Taiwan and every other semiconductor company in the world on September 15th. So they have a huge surplus of them saved, so they can survive for quite some time. But China doesn't have this high-tech technology right now. So this is a very good way to piss off the Chinese and or make them live up to the phase 1 trade deal. So tensions are rising without question. Now, before we just say Trump's going to have an easy election win, we got to look at the sheer size of this movement and how many people it has risen. So it could be a tighter race than I'm predicting, but right now I'm actually getting more and more confident that Trump will win, which is important for how we play the markets, obviously. Now, this is again looking at prisons. Early on, I was quite concerned, especially in February and March. That's how we predicted a stock crash, made clients a good amount of money. But it took me a while to change my belief that we were going to get out of this quite easily. And one of the things I had to ignore was that the prison systems were getting infected like crazy, as well as homeless populations. But there wasn't a bunch of sick or dead people arising from that. And so if you looked at the antibody data, you would think very few people have caught it. But then you look at the mortality, hospitalizations, and the active case count, and none of the numbers made sense. Everything was breaking. And bottom line is the weak died quickly. This probably has touched many more people than we can even imagine. And the testing doesn't pick up T-cell immunity. It only looks at severe cases that create antibodies. So the testing is missing. For every one person it's picking up, probably 8 have already had it and beat it with T-cell immunity, meaning no antibodies. Here's a look at a big city in China. So China is on the path to become the most powerful country within the next 1 to 2 decades. The US knows it. We can't stop them, but we can slow them down. And so that's basically what's happening. The two countries are connected almost like twins. And there's no way to kill one or the other without killing both, but you can sure slow them down. So that's going to be the big story of the next decade, is these different trade battles trying to slow the other down. Okay, so it looks like the main cause is simply being obese, and we can see it in the stats. Unfortunately, American population's 40% obese. If we compare it to Japan, very little obesity, and the deaths per million is directly correlated. So 10 out of a million dying in Japan versus 500 per million in the US. So that's almost directly 10 times greater on the obesity as well as the deaths per million. Here's the heat map. And so you can see there's really only hot spots in Hawaii. The rest of the country has completely fallen off the cliff with cases. And again, it looks like almost certainly the only people you need to worry about are the folks in the nursing homes. It does not make sense to keep schools shut down. It does not make sense to have restaurants operating at 25% occupancy. And the worst is behind us. See, it looks like we may have a question in the crowd. Sam, go ahead. Sam Gold. Just some crazy footage from the weekend. We're just briefly looking at. It's just showing the development of a civil war, which is not necessarily going to play a huge impact on financial markets unless it really spirals out of control. Sam, let's see. You have your hand raised, but you do have to unmute your microphone. And so this is exactly what we're predicting as this was hitting the peak, to not freak out, to buy stocks. And of course, that proved to be the right call. We've made a lot of money for our clients predicting this was not going to be a problem for these states. And now they're all crashing. So policy needs to change. Unfortunately, we're not seeing that. It does look like the Republicans want to change the policy and force it, and the Democrats do not. So same thing with the stimulus. Okay, very good. That does wrap up today's presentation. If you'd like to learn more, we do a longer segment for our pro members, which also has options trading. So again, if you want to upgrade your free trial, we do have a sale where you get in half off before Friday. And it comes with a bonus where you do get the pro strategy free for 30 days when you do get your upgrade. So we are sitting on the best return we've had in a single month at 8.86%. We've done that with a lot of cash on the sidelines, and that cash is standing by to hedge basically with treasuries and with the VIX at the right time. But right now, I am not concerned. I have zero leading indicators telling us to be worried. And really the only thing that is concerning is that HSBC bank, but that's again correlated to the Hong Kong real estate market, not the US market. Okay, last chance for questions, everybody. If not, we'll see you back tomorrow with your daily update, and we'll take a look at all the key news, markets, and data once again. Okay, very good, Brian. Let's go ahead and close today's issue out, and we will see you back tomorrow. Thanks, guys.